Everyone, as we mentioned, stock futures, they're still holding on to some gains ahead of the Fed's policy decision later this afternoon. The start of the easing cycle may yield more gains for an already strong market. Here with his take is John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. John, great to have you here with us. I mean, which camp are you in? We just got to know that. 50, 25, and how much volatility does a potential 50 throw into the mix right now?
Brad, great to be here on Yahoo Finance. Would have to say that we're looking for 25 bips, and we felt that way for quite a while. We had, thought before the last few months that it would likely be November and December that the Fed would begin cutting. But we think that the Fed chairman's mentioned that, they're going to expand their view here to emphasize the labor market in their dual mandate. Now, we know it's going to happen today. 99% sure, you never know, but we think it's a 25 bips. 50 bips, the problem here is that there's a lot of big money that is highly leveraged that's pushing for a 50 bips cut. That's the crowd that believes, the Fed's closer to a recession than not. We're not in that camp. We think the Fed has done a great job, but it's 25 bips today.
Yeah, the market repricing into 50, John, has absolutely fascinated me. It's been my Roman Empire over the past couple of weeks here. But I am curious. I know that we are within 1% of all-time highs, certainly inching closer to your year-end price target around 5,900, I believe. Is today an inflection point for this market?
It is, but likely not today in essence, but a little further down the road. We think, if anything, today, the 25 bips is likely to be greeted by the trading floors as time to sell the news after having bought the rumor. On the other hand, if it's 50 bips, the crowd that's looking for all those cuts from into next year, we think that they'll likely say there's some kind of a problem and recession risk is rising. So I don't think today will be a pronouncedly up day. If it is, I'll take it. But I won't be surprised to see, sideways movement or a drift slightly lower, or maybe a little bit more, not panic, but most certainly, some kind of negative pitch book throwing things down if the 50 bips crowd is annoyed and wants to throw a tantrum.
Give us the trade for both of these outcomes, John. 50 versus 25.
Brad, we have been big on cyclicals over defensives because we believe the Fed has done the right thing. Business has managed this transitional period back to sustainable growth. The consumer has shown up, whether you look at retail sales, even manufacturing, at least in the most recent data, looks like it's begun to pick up again. So we'd have to say that, where we are right now, it would be technology, communication services, consumer discretionary, and financials, we think are very important to own at this point. And of course, the industrials, with the likelihood that this year the government will finally get around to really spending all that money they set aside to invest in onshoring.
John, help me out in terms of the degree of upside movement that we're seeing in financials as we're heading into a rate cutting cycle, and how we can hold that view while still holding the view that tech is going to continue to rally. I don't get that.
Yeah, we think, related to financials, the big thing is what you want to look at is a normalization of the yield curve and the economy showing enough strength to continue to produce resilience. We're big on the large cap financials. Related to the regionals, we still think it's a little bit more of a risky bet in terms of what the individual companies within those indices that cover the regionals and the stocks themselves, in terms of their exposure to big businesses that are trying to get their employees back to the office and are having difficulty doing it. And the questions related to what do you do with buildings that you can't repurpose? So that issue remains a concern. But the big banks look like very well positioned here to continue a rally point, which they have begun in the second half of the year.
John, before we let you go, I want to get your take on some commentary we got from Jamie Dimon over the past 24 hours saying that the Fed rate cut is, quote, not going to be earth-shattering. The market's certainly not acting like that, though. Who's right here?
You know, I've got to say that I think he's got a good point here that in actuality, especially in hindsight, in the rearview mirror, when we look back at today and all the angst and debate as to what the Fed was going to do and what would be the outcome, that it will be a lot less important than it appears. The most important part of it is it's a beginning, a down payment by the Fed for Wall Street and Main Street to see that this is the beginning of the end of the rate hike cycle. His comments related to where the 10-year could trade, what is it? I don't know, 3 to 8% or something like that. At one point, I'm not absolutely positive. That's what I recall. You've got to figure. I think he's on the high side of that band. I think that's a little bit worrisome. But I think that's outside reality that we'll get to see. I think the Fed's doing a good job. I think the 10-year is probably going to trade from around to be priced to yield 3.7 to around 5%. Probably for the next year and a half. I think inflation, is something that takes a while to get rid of, but the Fed has really made remarkable progress in bringing it down to the 2.5–3% area. So here we go.
Here we go indeed, John. Thank you so much for joining us on this very special day. We really appreciate it.
Thank you.